You've probably heard somebody say, just put it all in a Roth and be set for life. But here's the truth. The Roth can either save you thousands in retirement or cost you thousands if you've used it at the wrong time. So how do you know what's right for you? Stick with me because today we're breaking down Roth IRAs, Roth 401ks, and Roth conversions in plain English with real examples, a handy table and strategies you can use right away. You can also look at tools from Vanguard or Bolden or Projection Lab to calculate Roth conversions as well. Welcome back to Reflections in Real Talk. I'm Judy, and around here, I take the mystery out of money. Whether you're in your 40s, 50s, or 60s and wondering if you're on track for retirement or you're already retired and trying to make sense of tax strategies, this episode is for you. By the end of today's talk, you'll know the key benefits of using Roth account, the real challenges that people run into, and the timing strategies that can make or break your decision. And trust me, once you understand these, you'll never look at your retirement accounts the same way again. Let's start with something fun. The Roth IRA actually has a namesake. It's named after Senator William Roth of Delaware. Back in 1997, he helped pass the Taxpayer Relief Act, which created the Roth IRA. The whole idea was to give Americans another option, one where you could pay your taxes up front, and then your retirement money grows and comes out tax-free. Think about that for a second. In the late 1990s, the thinking was, hey, taxes could go up in the future. Why not give people a way to lock in tax-free income for life? That's why we even have Roth accounts today. So how do they work? Roth accounts, whether it's a Roth IRA or a Roth 401k, use after-tax money. You've already paid tax on it. The magic comes later in retirement. Your withdrawals are tax-free as long as you meet the rules. Traditional IRAs and 401ks are the opposite. You put money in before taxes, which lowers your taxable income now, but you'll pay taxes on every dollar you pull out later. Now here's the big question. Is it better to pay tax now or later? Well, that depends on your tax bracket today versus what you expect to pay in retirement. If taxes go up and your income stays strong later in life, Roth wins. If your income and tax bracket will be lower in retirement, pre-tax might leave you with more. So let's compare the two. The Roth IRA, it has income limits. In 2025, for example, if you earn over $161,000 single or $240,000 married, you can't directly contribute. Contribution limits are $7,000 per year or $8,000 if you're 50 or older. Roth 401k, on the other hand, has no income limits. You can contribute even if you make $1 million. Contribution limits are much higher, $23,500 in 2025, plus $7,500 catch-up if you're 50 plus. And here's the kicker, if you're age 60 to 63, there's a super catch-up of $11,250 instead of $7,500. That means you could stash away up to $34,750 in those years if you can afford it. So Roth IRAs are great for flexibility, but Roth 401ks are powerhouses if your employer offers one. And many people don't realize you can actually split contributions between Roth and traditional inside the same 401k. Now, let's talk Roth conversions. This is when you take money from a traditional IRA or 401k and move it into a Roth account. The catch, you'll owe taxes on the amount you convert that year. So why would anybody want to do this? Well, because once it's in that Roth, it grows tax-free forever. Conversions are especially powerful in low-income years. For example, if you retire at 62 but delay Social Security until 67, you've got a 5-year window where your taxable income is lower. That might be the perfect time to convert chunks of your IRA to Roth at lower tax rates before RMDs or required minimum distributions kick in at age 73. But here are the risks. Converting too much can bump you into a higher tax bracket. It can also trigger Medicare surcharges or IRMA or cause more of your Social Security to be taxed. Timing and amounts are everything. And here's something people don't realize. Whether you're a single professional making $100,000 a year or a married couple earning $175,000 jointly, you're both in the 22% federal tax bracket in 2025. That means the short-term math looks about the same if everything else is equal. Say you contribute $10,000 pre-tax to a 401k. It saves you about $2,200 in federal taxes this year. That's like putting an extra $183 a month in your pocket. If your budget's tight, that can really help. But if you can handle a smaller paycheck now, going Roth means you'll never owe taxes on that money again. And here's a pro tip. You don't have to go all in either. Splitting between pre-tax and Roth creates what's called a tax diversification. That way in retirement, you can decide year by year which account to draw based on what makes the most sense. Think of Roth as insurance against higher taxes. You pay now, but you lock in tax-free income later. The trade-off is short-term pain for long-term peace of mind. And it's not about guessing, it's about running the numbers. That's why I've put together a simple worksheet that you can download in the description. And again, you can also use some online calculators from Vanguard or Bolden. Fill it out with your own numbers and you'll see clearly whether Roth, pre-tax, or a mix is best for you. Here's another angle people don't always think about, the bigger picture. The United States national debt is now over $34 trillion, and it's still climbing. That debt will have to be paid for somehow, and history shows us that higher taxes are one of the most common tools. That means even retirees who've once counted on lower tax brackets could find themselves facing bigger tax bills down the road. Planning with Roth accounts is one way to prepare for that possibility because you're locking in today's tax rate and insulating yourself from whatever Congress might decide in the future. And I love how retirement expert and author Ed Slott put it. He says that a 401k isn't really a retirement account, it's an IOU to the IRS. Every dollar in there is a shared account between you and the government. The question is, how much of it will the IRS want when you retire? The Roth flips that equation. You settle up with the IRS today and every penny grows afterwards is yours to keep tax-free. If you're finding this breakdown helpful, give this video a thumbs up so more people can see it. And hit that subscribe button if you'd like to continue receiving real-world money advice without the jargon. And hey, share this video with a friend who's thinking about retirement. It might just save them thousands. And now let's be real. A lot of people hesitate with Roth because of cash flow. They need the tax break now just to keep up with bills. That's not a failure, that's reality. Sometimes pre-tax is the smarter choice, especially if you're raising kids or supporting family. Another concern is tax uncertainty. None of us know what the future tax rates will be. That's why flexibility matters. If you've got both Roth and pre-tax money saved, you can pivot in retirement depending on what Congress decides. Here's one more benefit people often overlook. Roth accounts are a powerful estate planning tool. When you leave Roth money to your children or other heirs, they don't owe taxes on the withdrawals. Compare that to leaving them a traditional IRA, where every dollar they take out could be taxed at their income rate. Leaving Roth money gives your family a cleaner inheritance, free from surprise tax bills. So Roth or pre-tax, there's no one-size-fits-all answer. If your tax rate now is low, Roth might be the gift that keeps on giving. If your rate now is high but you expect it to drop later, pre-tax might save you more. And for many, the smartest move is to balance. The real win is being intentional, not just letting the default happen. Because when it comes to retirement, small decisions made consistently can add up to life-changing results. Thanks for watching today's Reflections in Real Talk, and don't forget to like, subscribe, and share this video with somebody who needs clarity about their retirement.